Ed Yardeni, Yardeni Research president and a Wall Street veteran, making some waves this morning with his latest call, writing, quote, "It no longer makes much sense for us to continue recommending overweighting the information technology and communication services sectors in an S&P 500 portfolio as we have since 2010. Ed's joining me now to break down why he's making this call and some of the risks facing investors with increasing market concentration. Ed, thanks so much. This is a big change for you guys, we should say, first of all. So for 15 years, you have said overweight, not just big tech, but also you have been bullish on the Magnificent Seven, right? And so what has changed for you? What was the sort of tipping point that changed your thinking on this?
Well, they've worked awfully well to the point where if you look at the S&P 500, information technology and communication services, just those two sectors out of the 11 sectors in the S&P 500 account for 45% of the market capitalization of the S&P 500. So we really have had a tremendous amount of concentration in just two of the 11 sectors. And that in turn suggests that maybe it's time to look elsewhere. It's hard to recommend overweighting something that's already so overweight in the S&P 500 relative to its importance in the economy. So I'm recommending continuing to overweight, maybe adding to overweights in financials, in industrials, and now also recommending healthcare, which happens to be one of the biggest industries in America.
And just to sort of level set here, for people who aren't always familiar with the way we talk about things on Wall Street.
Sure.
So the S&P 500 has a certain percentage of it is made up of tech and healthcare, et cetera. That
Correct.
Percentage for tech is now 45%. So when you say overweight, you mean people should hold more than the weighting in the index would suggest.
Than the index, correct.
If you're neutral, it's the same. If you're underweight, you hold less. Yeah. Right.
Yeah,
so people know what we're talking about.
Yeah, exactly. I'm not recommending that they go from 45% to 65% in their own personal portfolios. Quite the opposite. I'm saying 45% already seems to be an awfully stratospheric percentage share of the market, and it's probably a good idea to look for some rebalancing of the portfolio. In other words, I'm arguing for some diversification. And that's been the concern that a lot of people have had, is that the market itself, I mean, the S&P 500 is a portfolio. There's a committee that actually picks that. And that portfolio right now is very concentrated in just two sectors. And I'm just saying that relative to that portfolio, you might want to trim back a bit and have certainly no more than what the index actually has.
So, Ed, though, to your point, it has worked well for quite a long time. And as long as it's been working, we've been having that market concentration debate, right? And people have brought it up as a potential issue. So it would seem to suggest to me that it is not just concentration alone that's the issue. Maybe you also, do you think that there are growing risks at all to that dominance that we have seen?
Well, the Magnificent Seven, the information technology sector generally is very competitive, and it's become more competitive. Maybe a useful analogy of the Magnificent Seven is the Game of Thrones, with that opening credits where they show the various kingdoms and how some are rising and some are falling. And for a long time, the Magnificent Seven all seemed to have a moat around them and could just kind of maintain a certain monopoly in the kind of businesses they have. Now with AI, it's kind of the Wild West for them. They have to suddenly spend a lot of money. They suddenly are saying that they're competing against each other after all. And then there's all these startups. There's almost no barrier to entry in the information technology these days. Anybody with any sort of cockamamie AI ID may very well get funded and come up with something that could create large language models, these AI models, cheaper with chips that aren't as expensive and don't need as much air conditioning, and all that's on the way. So there's a lot of dynamics going. It's kind of like a horse race that just will never end. For a while there, it looked like NVIDIA was ahead of the pack. Now it looks like Google is ahead of the pack, but that could change from day to day.
Yeah, and I don't know where the red wedding would be in this analogy if we're sticking with Game of Thrones.
We don't want to go there.
No, we don't. So Ed, you mentioned, and I know you're still bullish on the S&P 500 overall for 2026. 7,700 is what you're looking at there. So talk to me about those other sectors that you mentioned and what you think could be catalysts there, something like healthcare, for example.
Well, well, I'm telling everybody to, be a little less exuberant about the technology companies, the ones who produce technology. I'm basically arguing that the S&P 493 outside of the Magnificent Seven, that they are technology companies. Every company now really has to be a technology company. You either make it or you use it. And I think more and more companies are going to find that the technologies that the producers are coming up with, both in terms of hardware and software, do lend themselves to increasing efficiency, to increasing productivity. And you've got to do that, because if you don't do it, your competitors will do it. So, the healthcare industry, I mean, I can't think of an industry that's more ripe for technological innovations to increase productivity than healthcare. We all know just how, go doctor to doctor or hospital to hospital, how you have to fill out the forms and how long these things take. Well, now I see signs, just in my personal observations, that things are changing very rapidly in the healthcare industry to provide more productivity. There's something called EPIC, where the hospitals now share digitally their information about patients. So you don't have to kind of go to some office at one hospital to get copies of a disc to show a doctor at another hospital. So there's a lot of that going on. Financials, fintech is really a hot development. We are going to see more and more developments. I mean, stablecoin, I think, is going to be sort of the Venmo for the financial system, broadly speaking.
Right.
I still don't know why we deal with checks, quite honestly, and I think that'll be gone pretty soon.
Well,
and industrials, same story.